Ladies and gentlemen, I need you to pull up your terminals and rigorously re-examine the risk readings flashing on your dashboard. Ask yourself, is the current market sentiment building a skyscraper on a foundation of fragile complacency? As you stare at the green P&L columns and the unrealized paper gains in your portfolio, have you deluded yourselves into thinking that alpha is low-hanging fruit? Maintain your professional skepticism. We are not here to celebrate a paper victory. We are here to survive the war. We need to subject the fundamentals to a cold, hard, unyielding stress test. What I am showing you right now is not designed to grab headlines through cheap fear-mongering. It is an objective deduction based on granular macro data. Look at the current long-wave economic cycle. What signals is the model outputting? I see no factors supporting long-term prosperity. I see no support levels for a continued bull market. What I see forming on the horizon is an imminent, structural, and violent liquidity crunch. Make no mistake, this is a brutal repricing of asset valuations waiting to happen. The institutional exit mechanism has already been triggered. The smart money is quietly distributing, while retail capital, lacking risk exposure management, is still blindly leveraging up to buy the top. You think this is overly bearish? You think this is a black swan tail risk without data support? Fine. Today, let's skip the boring macroeconomic theory. Let's shelve the complex technical analysis and the Elliott wave counts. Right now, I am delivering a set of institutional-grade risk hedging solutions directly to your desk. I will pass the core logic of defensive asset allocation straight into your hands. Please, I implore you, stop discussing amateur topics like does market beta have more upside immediately. That is a distraction. When systemic risk shocks the market, the core metric is never the amplitude of volatility, it is the solvency resilience of the balance sheet. On the eve of this valuation bubble bursting, at the absolute peak of this irrational exuberance, I have screened a list of assets that belong to the deep defense category. Allocating to this list is not about chasing aggressive excess returns. It is about capital preservation. The goal is to make your portfolio the surviving minority, the unsinkable objects in the coming wave of market clearing. Sharpen your focus and mark these tickers. Do not just watch them, own them, because they are your future liquidity lifelines. First, we must deconstruct the true retail titan, the absolute anchor of counter-cyclical asset allocation, Walmart. Do not underestimate the depth of this retailer's moat. During an economic expansion cycle, you might scoff at its margins or ignore its intrinsic value, thinking it lacks growth elasticity compared to tech. But listen to me. When the macroeconomy turns down, when asset prices deflate, when the wealth effect evaporates, and when you face layoff risks, Walmart represents rigid demand. It is the last line of defense for the US consumer economy. Why do I define it as the king of countercycles? Because there is a brutal but effective economic logic here. Once a recession cycle begins, that massive middle class, previously accustomed to the organic aisles of Whole Foods or the discretionary aisles of Target, will see their purchasing power instantly downgraded. Their consumer psychology will undergo a structural shift, forcing them to swallow their pride and flow back into the Walmart ecosystem to hedge against inflation pressure. This is the classic trade-down dividend. Walmart is like a massive liquidity black hole, absorbing all purchasing power squeezed out by the economic downturn. Its supply chain management is hyper-efficient, serving as a deflationary force, and it possesses pricing power that crushes competitors. In a potential hard landing scenario, Walmart's foot traffic will rise against the trend and its free cash flow will remain robust. Longing Walmart is essentially longing the irreversible trend of social consumption downgrading. It is not just a ticker symbol, it is a hedging tool against social turbulence. Next, we discuss the giant with extreme defensive attributes, Procter & Gamble. I define it as the king of resilience. Think about the psychology here. If market liquidity dries up tomorrow, if economic activity comes to a full stop, will you cut spending on cleaning supplies? Will you stop personal care? Will you interrupt the purchase of baby essentials? Obviously not. This is P&G's foundational business logic. Brands like Tide, Gillette, and Pampers construct a non-cyclical matrix of consumer staples. This is non-discretionary rigid demand. Furthermore, P&G's core advantage lies in its pricing power and brand loyalty. When CPI numbers soar, P&G raises terminal prices. Consumers may grumble, but they find it difficult to switch to white-label generic products because the switching costs and quality risks are objective realities. That is a moat as wide as the Pacific Ocean. More critically, look at the shareholder return. P&G has increased its dividend for 67 consecutive years. 67 years, everyone! Think about what that timeline covers. The Cold War, the oil crisis, the dot-com bubble, 9/11, the Great Financial Crisis, COVID-19. Through every geopolitical shock and macro upheaval, P&G continued to cut checks to shareholders. In a future cycle where volatility spikes, this deterministic free cash flow is worth far more than safe haven gold. Following that is the familiar liquid asset Coca-Cola. Do not simply classify it as a beverage manufacturer. This is a legal distributor of addictive consumer goods. It is a cash flow compounding machine. Its global distribution network permeates every capillary of the economy, from the high-rises of Manhattan to the rural villages of emerging markets. Even where infrastructure is scarce, you can still reach a Coca-Cola. This is unparalleled market penetration. During an economic depression, big-ticket consumption like cars and luxury goods may stall, durable goods demand may hit zero, but paying a few dollars for an ice-cold Coke to get that instant dopamine hit is a luxury everyone can still afford. This is the lipstick effect in action. Furthermore, as a dividend king, its yield is extremely stable. When you watch tech growth, valuations collapse, and your screen turns red, that notification of a quarterly dividend deposit from Coke will be the only stabilizer keeping your portfolio and your sanity afloat. Since we are talking about beverages, we must mention its rival, which I believe holds equal weight in a defensive portfolio, PepsiCo. Many investors suffer from a severe cognitive bias, thinking Pepsi is limited to carbonated drinks. Wrong! Pepsi is a food giant disguised as a beverage company. It owns massive snack lines like Lay's, Doritos, and Quaker Oats. This gives it a superior diversification hedge compared to Coke. Think about the consumer behavior. When unemployment rises and anxiety spikes, snack consumption rises in tandem with soft drinks. This low-cost caloric intake is a deep-seated psychological mechanism for stress relief. Pepsi's beverage plus snack dual drive model makes its risk resistance comparable to a financial armored vehicle. No matter how the economic cycle rotates, basic caloric intake is rigid. That is Pepsi's core secret to crossing cycles unharmed. Next, we enter the healthcare sector, absolute rigid demand that transcends all cycles. The first pick is Johnson & Johnson. I mention this company with the utmost seriousness. It is one of the few companies left globally rarer than a unicorn with a AAA credit rating. Do you understand the magnitude of that? It means in the rating agency's risk models, J&J's credit default swap risk is lower than the United States Treasury. The federal government might shut down over debt ceiling political theater, but J&J will not. Its balance sheet is solid as a rock. Even if the financial system melts down and the banking sector faces a liquidity crisis, J&J remains steady. It possesses two core pillars: medtech and innovative medicine. Whether it's key operating room equipment or blockbuster immunology and oncology drugs, it dominates the market. Buying J&J is essentially going long on the infrastructure of the entire medical system. In moments of market panic and widening credit spreads, J&J is the safe haven where you can confidently park your core capital. Then there is Merck. I also give this a strong buy rating as a bear market alpha source. Why? Because it holds the pharmaceutical blockbuster, the anti-cancer drug Keytruda. Here is a brutal macro fact. Disease does not read news headlines. Cancer does not care if the Fed hikes or cuts rates. No matter how ugly the GDP data looks, patients' treatment needs are completely inelastic. Keytruda's dominance across multiple tumor indications provides Merck with predictable, robust revenue growth. Even if the S&P 500 crashes, as long as Keytruda's patent protection is valid and its clinical efficacy is proven, Merck's performance has the hardest floor imaginable. It is the best offensive target within the defensive category, the high Sharpe ratio asset your portfolio desperately needs. Let's look at United Health Group. This is the absolute hegemon of the US managed care industry and the ultimate wielder of pricing power. You understand the US medical cost structure. Without insurance coverage, you can't move an inch. United Health sits at the top of the entire healthcare value chain. It has massive scale effects, squeezing costs upstream from pharma companies and hospitals, while passing costs downstream to consumers and corporations. Medical inflation? No problem, it passes right through via premiums. As the largest health insurer in the US, it acts like an infrastructure toll booth. No matter how the economy fluctuates, if medical activity exists, you must pay the toll. This business model may seem cold, but for investors, it is a perfect cash flow printing press. Its earning stability is enough to make any high volatility tech giant blush. Finally, at the ballast position of this portfolio, we must allocate to utilities, Duke Energy, and Southern Company. I know, these two companies have extremely low beta values, so low they seem boring. But, ladies and gentlemen, in the world of institutional investing, boring is beautiful. Boring means low volatility. Boring means safety. They are regulated utilities with natural monopoly attributes. If you live in their service area, you have no choice but to connect to their grid. It is a zero-sum game. Whether your personal balance sheet is expanding or in recession, basic energy consumption is rigid. This guarantees absolute revenue stability, almost decoupled from the economic cycle. Furthermore, they are bond proxies. While high interest rates have temporarily diluted their dividend appeal, listen closely. If a recession is confirmed, the Fed is bound to pivot to rate cuts. Once the yield curve heads down, these high dividend utility stocks will see instant valuation repricing as capital hunts for yield. They are the anchors in your portfolio, ensuring you don't suffer a catastrophic drawdown in the storm. The watch list has been delivered. Now, I know some aggressive investors will object, but these traditional companies lack imagination. I want growth. I want 100% returns. Stop. Stop this irrational greed. To make you completely abandon your fantasies, and to prove this list is based on rigorous quantitative backtesting results, let's review history. Let's examine how these companies provided excess returns during past liquidity crises. Historical data is the best stress test. It is cruel, but it never lies. Let's set the backtest to 2022. You remember that year vividly, don't you? Inflation out of control, the Fed hiking aggressively, the Nasdaq crashed 33%, the S&P 500 fell 19.4%. All growth tech stocks underwent a valuation slaughter, your Tesla was cut in half, your Amazon market cap plummeted. But in that moment of rock-bottom risk appetite, how did our bear market hedge Merck perform? It bucked the trend and rose 45%. Did you hear that? The market crashed double digits and it booked a 45% positive return. This is because of strong Keytruda sales and institutional money flooding into healthcare for safety. Coca-Cola? Up 7.4%. PepsiCo? Up 4%. J&J? Up 3%. While you were suffering massive drawdowns, investors holding these defensive assets were earning positive returns. Why? Because no matter how high inflation gets, demand for consumer staples and healthcare is rigid. The lesson of 2022 is that in an inflation and rate hike cycle, staples and healthcare are the only sectors that can deliver positive yield. Go back further to the 2020 COVID meltdown. That was a true liquidity crisis. The VIX panic index exploded, and the S&P 500 plunged 34% in a month. The whole world was dumping assets for dollar liquidity. But how did Walmart perform? It only dipped slightly, by 3% to 5%. In a crash where global asset correlations trended toward 1, that is a statistical miracle. Why? Because when the market thought the end of the world had arrived, Walmart became the infrastructure maintaining social function. Panic hoarding, toilet paper, food runs. Walmart became the core of material security. When the broad market crashes, its maximum drawdown is usually half or less than the index, preserving the principle you need to fight another day. If that sample size isn't enough, go back to 2008. The global financial crisis, the worst recession since the Great Depression. The global financial system was on the brink of collapse. The S&P 500 crashed 38.5% for the year. If you were heavy in financials or real estate, your net worth went to zero. But in that year of total loss of confidence, Walmart actually rose 18%. Check the data, up 18%. This is the classic counter-cyclical effect. The worse the economy gets, the more foot traffic flows to Walmart. This is why I give Walmart the highest weighting. It is the true source of alpha in a recession. So, everyone, are the market signals not clear enough? Look at current valuation levels. The S&P 500 PE ratio is nearing 30x, and the price to book is in the 99th percentile of historical ranges. What does that mean? It means valuation bubble extreme values. It means the risk-reward ratio is extremely mismatched. History has proven countless times that when valuations deviate by this standard deviation, only one thing follows mean reversion. And the process of mean reversion is not a gentle glide, it is a crash. It is a collapse. It is asset price resetting. At this critical juncture, do you still expect those tech stocks with dream rate valuations to provide protection? Stop dreaming! When liquidity tightens, the liquidity of those stocks will go to zero. They are toxic assets. But the doomsday arc list I gave you today, Walmart, P&G, Coca-Cola, Pepsi, J&J, Merck, United Health, Duke Energy, Southern Company, they are your only survival hedge. What is the bottom line? The underlying logic is don't try to be a hero. Don't try to earn every single basis point of return. In this extremely asymmetric market risk environment, the priority is absolutely not chasing high beta, but avoiding permanent loss of principal. Preserve your core capital. Rotate your positions out of those high valuation bubble assets and move everything into these defensive fortresses that have passed historical stress tests. This is like equipping a parachute before the plane enters a tailspin. You might feel like you're underperforming the market right now, feeling the burning sensation of FOMO while watching others party in the bubble. But listen to professional advice. When the storm truly hits, when everyone is panicking, when your peer is crying that his 401k has shrunk by half, you will thank this strategy. You will be grateful to the version of yourself that listened to this analysis today. Do not be misled by the noise of mainstream media. Do not be fooled by those sell-side analysts. They just want you to provide exit liquidity for their institutional clients. The market is a cruel zero-sum game. When the tide goes out, only those holding these core defensive assets will survive. Listen, I do not want to see you disclosing bankruptcy in your reports a few months from now. I do not want to see your accumulated wealth evaporate overnight. Execute the strategy immediately, right now. Cleanse your portfolio. Build your safe haven. Keep liquidity. Keep safe. Only the paranoid survive. That is the full market analysis for today. Remember my logic. I'll see you next time.